Hi guys, welcome to Infinity Learning Space, and today in this video we are going to learn principles of consolidation. So basically the concepts and the principles that we have to follow when preparing a set of consolidated financial statements. Right. So the first thing we'll look at is the relevant accounting standards. What are the accounting standards that we have to follow when preparing consolidated financial statements? So we have 6 accounting standards beginning with SLFRS 10, SLFRS 3, LKS 27, LKS 28, SLFRS 11 and SLFRS 12. Right. So in this video, we will be focusing mainly on the first 3 standards. That's SLFRS 10, SLFRS 3 and LKS 27. So we don't really have to go into detail about what's covered in each of these standards at the moment. We'll get into that probably in the next video. Right. So before we start learning the theory behind consolidated financial statements, let's look at a real world scenario. Right. So we are going to be looking at the financial statements of Ceylon Cold Stores PLC. It's a company that all of us are familiar with, maybe not using this name, but if I say Elephant House ice creams and soft drinks and Keel Supermarket, I think it's a company that all of us are familiar with. It's a John Keel's company, and as you can see, it's listed on the Colombo Stock Exchange. Right. So let's look at the balance sheet of Ceylon Cold Stores PLC. You can see it's a typical balance sheet. You get the assets classified by non-current assets, current assets, and then you get equity, and then you get the liabilities. So it looks like a normal balance sheet. And this balance sheet is prepared as at March 2020, and we know as per LKS 1, when you are giving values for a particular year, you need to give the values for the previous period as well. That's what we have here. This is what we call comparative values. Right. So then these 2 columns are under the heading company, and then to the right of that we get 2 other columns for 2020 and 2019, and that's under the topic group. So now, since this is Ceylon Cold Stores PLC, it's reasonable to assume that the company, this balance sheet must be for Ceylon Cold Stores PLC. Then if this balance sheet is for Ceylon Cold Stores PLC, whose balance sheet is this? What do you mean by the word group? Whose balance sheet is this? Right. So to understand that, right, actually before that, you can see the values for each line item in the balance sheet is different for the group and for the company. So you can see here for the group total assets is 37 billion, while for the company it's 14 billion. Right. So to understand what this group is, we need to look at the ownership structure of Ceylon Cold Stores PLC. Right. So you can see Ceylon Cold Stores PLC is the main company that produces soft drinks and ice cream, and under that Ceylon Cold Stores PLC has 2 subsidiaries, 100% owned 2 subsidiaries. So we have JK Marketing Services Private Limited. They are the ones who operate the Keel Supermarkets. Then Colombo Ice Company Private Limited, that's the company that produces ice cream. Right. So then when you put all 3 together, when you consider all 3 companies together, we create something called a group. Right. So the group refers to all 3 companies together, and these financial statements we saw here, this balance sheet we saw here, shows the assets, equity and liabilities of all 3 companies, not just Ceylon Cold Stores PLC. So this balance sheet here under company shows only the assets, equity and liabilities of Ceylon Cold Stores PLC, while this balance sheet here shows the assets, equity and liabilities of all 3 companies, and all 3 are put together we call the group. Right. Okay. So that's a brief understanding about what consolidated financial statements are about. Right. So let's get into the theory. Let's see exactly how a group is formed. Right. So we know ordinary shareholders of a company own the company. They are the ones who own the company. It's not the preference shareholders, it's not the debt holders, it's not the bank. Right. It's the ordinary shareholders that own a company. And as a result of this ownership, right, ordinary shareholders get something called control, meaning they are the ones who make the most significant decisions. The companies manage according to their wishes. And how do they get this control? Because when you have ordinary shares, as a result of that, you get voting power, and using that voting power, you can control the company directly and indirectly. Now, if I explain what directly means, now ordinary shareholders are able to vote for resolutions at shareholder meetings like annual general meeting, extraordinary general meeting. So, if they don't like a specific decision taken by the board of directors, they can shoot it down, or they can prevent it from happening. Similarly, they can approve decisions that they like. Then indirectly, the shareholders can control a company because they are the ones who appoint the board of directors, and board of directors manage the company on behalf of the shareholders. And if the shareholders are not happy with the performance of the board of directors, all they have to do is appoint a new set of directors. So indirectly and directly, the ordinary shareholders are able to control the company. Right. So the same way, an individual can own shares in a company, one company can own shares in another company. So in this example, let's see, company A owns 100% of the ordinary voting shares of company B. So company A is the investor because he has invested in the shares of company B, and company B is the investee because it's his shares that company A has invested in, right? And as a result of this ownership, as we saw before, company A gets control over company B, right? So company A owns 100% of the ordinary voting shares. So he is the investor, company B is the investee, and as a result of this ownership, company A gets control over company B, right? Then if one company has control over another company, we call that company that controls the other company the parent, right? And the company that is controlled by the parent is called the subsidiary, right? So let's look at the definitions as per the accounting standards. So a parent is an entity that controls one or more subsidiaries. So in this example, company A is able to control company B, making him the parent. Of course, in this example, there's only one subsidiary, but it's more than possible for a parent to have more than one subsidiary. So there can be multiple subsidiaries for a single parent, right? Then the subsidiary is an entity that is controlled by another entity. So company B is controlled by company A. Company B is controlled by company A, making him the subsidiary, right? And then when you consider both of them together, right, we create what we call a group, right? Both of them together, the parent and the subsidiary together, we call a group, right? So this group is an accounting concept, right? Legally speaking, there is a company here, there is a company here, and there is no legal company called the group. It's just an accounting concept that we are going to create, right? So legally company A, company B, but for accounting purposes, we are going to assume company A and company B can be put in one big economic entity called the group. So company A and B form what we call a single economic entity, meaning even though legally there are two different companies, because company A controls company B, we can think of both of them as a single economic entity. And when we prepare consolidated financial statements, we prepare the consolidated financial statements for this group. So in consolidated financial statements, we don't see company A or company B, right? What we see is the group, meaning both of them put together, right? So consolidated financial statements are financial statements prepared showing the assets, liabilities, equity, income, expenses and cash flows of both company A and B put together, right? And this is a faithful representation. What do you mean by that? So we know useful financial information has two fundamental characteristics. First one is relevance and the second one is faithful representation. And what does faithful representation tell us? It tells us that in accounting, what you need to focus on is the economic substance of a transaction or the economic reality, how things are practically. We don't care about how things are legally. We are not lawyers, we are accountants. So we are going to be focusing on the economic reality. and doing this is a thing that is in adherence with faithful representation. Why? Because we are not going to look at company A and B separately. We are going to look at both of them and say, you know what, it's a single economic entity. You can think of the group as one big company, but keep in mind it's not an actual company, it's something we create for consolidated financial statements, right? So then doing consolidated financial statements is in adherence with what we call faithful representation. We know in useful financial information, we need to have two fundamental qualitative characteristics, right? The first one is relevance and the second one is faithful representation. And faithful representation tells us that we have to look at the economic reality or the economic substance of a transaction and not the legal form, right? We are accountants, right? We don't care how things are legally. Of course, we have to adhere to rules and regulations. But when it comes to accounting, what we need to look at is the economic reality, how things are practically, right? So now looking at both company A and B as one big company called the group is in adherence with faithful representation, because we are looking at the economic reality, not the legal form. Even though company A is a separate legal company, company B is another separate legal company, we don't care about that. We are going to put both of them together and create an economic entity, right, that we call the group, and the consolidated financial statements are prepared for that group, right? Then next thing we have to understand clearly is this word control, right? This word control. Now an investor and an investee is linked using this word, right? So a parent and a subsidiary are created when the parent can control the subsidiary. There won't be a parent and a subsidiary if company A can't control company B. So what's really important is this word control, right? So we need to understand what this control means exactly, right? Control, right? So according to SLFRS 10, for an investor to have control over the investee, there needs to be 3 requirements. So control is a result of 3 requirements. The first one is power over the investee, meaning the investor, right? Now in this example, investor is company A. We are not going to call him parent yet because we don't know whether he has control. We are trying to check whether he has control. So we are going to call him investor. He has invested in the shares of investee, right? So the investor needs to have power over the investee. That's the first requirement. Then exposure to or rights to variable returns from his involvement with the investee. The last one, the ability to use its power over the investee to affect the amount of investors' returns, right? So all of this sounds a little complicated. Let's get into each one and see what they mean, right? So first one, power over the investee. So power again is defined as the existing rights that give the current ability to direct the relevant activities of the investee, right? So first one, it is existing rights, meaning the entitlements or authorities. So the investor has an entitlement or an authority that gives him the ability to direct what we call relevant activities, meaning he has a right that gives him the ability to make the decisions regarding activities we call relevant activities, right? Okay, so what are these relevant activities? So relevant activities are defined as activities that significantly affect the investee's returns, right? So remember, investees meaning company B's, right? Company B's returns, right? So now let's look at this using an example. Let's say now we know any company, right, has a range of operating and financing activities that significantly affect their returns, right? So some of the main activities are manufacturing activities. Now they involve activities like activities and decisions like what to produce, how much of it to produce, and what should be the quality of our products, right? Then we have marketing, selling and distribution activities. So after we have manufactured, or even before we manufacture, we have to decide at what price are we going to sell, whom are we going to sell it, how are we going to distribute our products, right? So these are marketing, selling and distribution activities. Then determination of the capital structure. We have to decide how are we going to raise money. Are we going to raise money issuing shares, or are we going to take a bank loan? And if we are taking a bank loan, how much should the bank loan be? That means what's the size of the bank loan? So all these activities and decisions have a direct impact on whether a company is a success or a failure. It has a direct impact on whether the company is going to make profits and positive cash flows, right? So these activities will decide how much profit the company is going to make, how much cash the company is able to generate, and how successful the company is going to be. So all those things we can explain in other words as these activities affecting the company's returns. So these activities affect the investees' returns. These activities affect the returns generated by a company. These returns can be dividend, capital appreciation, and let's say a company goes into liquidation, then the residual interest the shareholders have in the assets of a company after liabilities are paid out. That's also a return. So these activities have a direct impact on all those returns. And whoever who has the ability to direct the relevant activities has power over the investee, meaning whoever who can decide how these activities are done is said to have power over the investee, right? So let's look at a closer example. You can see here company C is a car manufacturer. Company X owns 100% of company C. C has a number of activities that significantly affect its returns. So these are relevant activities because these activities significantly affect its returns. So these are relevant activities. First one, decisions about capital expenditure. Now this is a car manufacturer, so he has to make decisions like how many factories to have, what should be the capacity of those factories, and are we going to have an automated production process or is it going to be a more manual process. Then decisions on the selection of suppliers and production schedules. So we have to decide from where are we going to get our raw material, who are our suppliers, right? How much are we going to produce and when are we going to produce. Then the last one, decisions on product range and pricing. We need to decide what car models we are going to manufacture and at what price are we going to sell them. So all these activities, like I said before, has a direct impact on the success or the failure of a company. In other words, the returns of the company, right? Then the overall decision making is done by key management personnel. So key management personnel are people like the CEO, the Chief Operating Officer, the Chief Financial Officer, right? So key management personnel are mainly people like that, very senior management, who are appointed by the board of directors. The board is appointed by the shareholders at each year's AGM. So shareholders appoint the board of directors employ the key management personnel, and they are the ones who run the company on a day-to-day basis, right? So now the question is whether company X has power over company C, not control. We are looking at power right now. Remember, power is just one component of control, and we are trying to see whether investor has power over investee, right? Now, by the looks of it, it looks like key management personnel, the senior management, right? They are the ones who take all the important decisions. It seems like they are the ones who make the decisions related to all these activities, right? But the thing is, those decisions taken by the key management personnel need to be approved by the board of directors. And in return, the board of directors are appointed by the shareholders, in this situation, company X. So if the shareholders are not happy with the way board of directors are performing, they can just replace them. So even though these guys are the ones who might take this decision, these decisions are subjected to the approval of the shareholders. That means actually the ultimate power, the ultimate ability to direct the relevant activities are with the shareholders or company X. So company X indirectly direct the relevant activities of company C. Not directly, but indirectly direct the relevant activities of company C. They might not make decisions on a day-to-day basis, but when it comes to all the important decisions, they are the ones who have the final say. Right. So then company X has power over company C. So company X has power over C because ultimate direction of all activities is decided by the board of directors, that is by approving decisions made by the management who are appointed by the shareholders at the annual general meeting. So yes, these the decisions taken by the key management personnel need approval of the directors, but they also are appointed by the shareholders. So ultimately, they are the ones who direct the relevant activities of company C, giving company X power over company C. Right. So we know power, right, is an existing right, and these rights can be of different forms, right? So the investor can get these rights in different forms. One method, the most common method, is by having majority of voting rights. So if an investor has majority of the voting rights, meaning more than 50% of the voting rights of an investee, then obviously the investor has power over the investee, because if when he has more than 50% of the voting power, he can appoint majority of the board of directors, and then he can have the final say in any resolution discussed at a shareholder meeting. So because of that, he can have power over the investee. Then there are also situations in which it's not really necessary to have more than 50% of the voting power. You can still have power over the investee if you have the right to appoint, reassign, remove key management personnel who direct the relevant activities. So even if you don't have majority of the voting rights, you can still have power over the investee when you are able to appoint, reassign and remove key management personnel, because they are the ones who will direct the relevant activities, and if you are the one in charge of them, right, you indirectly direct the relevant activities. Right. Then the last three situations are also similar. So right to appoint or remove another entity that directs the relevant activities, right to direct the investee to enter into or veto changes to transactions for the benefit of the investor, decision making rights arising from management contract. Now for example, in a situation where you have less than 50% of the voting power, you can still direct the relevant activities, because through a management contract with the other shareholders or with the company, you have the final say in the relevant activities. You have less than 50% of the voting power, but still through a management contract, you are put in charge of making all the decisions related to relevant activities, thus giving you power. Right. Then let's look at conditions 2, right? It says exposure to or rights to variable returns from the involvement with the investee. So the investors return from the investee. Now the investor has invested in the shares of investee and he should get something in return, right? He doesn't invest for the fun of it, no. He is going to get something in return, right? And the returns that the investor is going to get should be variable, meaning it should not be fixed. Variable means the returns that the investor is going to enjoy should change depending on the performance of the investee. So in a year that the investee does really well, he makes a lot of profit, generates a lot of cash and is doing really well, the returns the investor will enjoy will be high. The returns the investor will enjoy can be dividend, capital appreciation, right? Those are forms of returns. And then in a year the investor is not doing so well or is loss making, the returns the investor will enjoy will be low, right? So he will not get dividend and the share price might not go up. So the returns that the investor will get from his investment in the investee needs to vary with the performance of the investee, right? Last one, the ability to use its power over the investee to affect the amount of investors' returns, right? So this last component links the first two. It's a linkage, right? So this says, yes, you have this, great, but you need to have the ability to use this power to affect these returns. So here actually what we are looking for is whether the investor is an agent or a principal, right? We know agent is someone who is going to act on behalf of someone else, and principal is someone who appoints an agent to act on his behalf, the agent-principal relationship, right? And if the investor is an agent, he does not meet this requirement, so he does not have control. And if the investor is a principal, he meets this requirement, and if he meets these two also, he will have control. So if you look at board of directors, right, we know they are agents of the shareholders and they are the ones who take some of the most important decisions, but they don't have control over the company because they are simply acting as agents of the shareholder. They are not principals. So because of that, they don't meet this requirement and they don't have control over the company, right? So these are the three requirements that need to be satisfied for an investor to have control over the investee. All three need to be there, not just one, not just two, all three need to be there for the investor to say he has control over the investee. And once the investor has control over the investee, a parent subsidiary relationship is created and we get this purple circle, the group is formed, right? So next, just wrapping up control, right? So we normally assume, especially in exam questions, that the investor has control over the investee if the investor has more than 50% of the voting power, meaning if the investor owns more than 50% of the ordinary voting shares, we assume that the investor has control over the investee, right? We don't really have to analyze it a lot. In an exam question, if they say he owns more than 50%, we can say yes, he has control, right? However, like I said before, it's not necessarily a must to have more than 50% of the ordinary voting shares to have control. Even in situations where you have less than 50% of the ordinary voting shares, you can still have control, right? So in this example, we can see company X owns 40% of the voting power in company Y and company C owns the balance 60%. So if company X owns 40% of the ordinary voting shares in Y, the balance 60% is owned by company C, right? Now, by the looks of it, right, company C seems to have control over company Y because obviously he has more than 50% of the ordinary voting shares. And we might think that he is the parent, he is the subsidiary, and there's a group linking company C and Y, right? But let's look at the facts. Company C has entered into an agreement with company X such that company C will exercise its voting power in the way company X wants. So now there's a new thing. Company X and C have what we call an agreement. They have come into an agreement where company C says, you know what, I have 60% of the voting power, but I'm going to use them in the way company X wants. So even though company X only owns 40%, this 60% will also be used in the way company X wants. Company C has it, but it will be used in the way company X wants, right? Okay, so in that situation, even though company X only directly has 40%, because he can also decide on how this 60% will be used when it comes to a shareholder meeting or when it comes to appointing directors, company X will have control over company Y. He directly has 40, he on his own has 40, but this agreement gives him the 60% from company C as well, creating a parent subsidiary relationship and a group. Now you might ask, why would company C give that to company X? Why would company C agree to use the voting power the way company X wants? Now let's say company Y operates in a very specialized industry. Let's say pharmaceutical industry. It's a very specialized high-tech industry, right? Not everyone can operate, not everyone has the expertise to do it, right? Let's say company X is a veteran. He's like someone who has been in the pharmaceutical industry for a very long time. So he knows in and out of the pharmaceutical industry. And company C is a new guy, right? So when he invests in company Y, yes, he has the majority of the voting power, but he says, you know what, I don't know anything about pharmaceuticals. Let me use my voting power in the way you want because you're obviously an expert. So I think I will benefit better if you use my voting power, right? So that's an example where through an agreement, company X can have more than what he directly owns. So he directly owns 40%, but because of the agreement, he gets more than 50%. And then he has control over company Y and a group is formed, right? Then, so now we understand who a parent is, who a subsidiary is, and what consolidated financial statements are, right? So let's have a clearer understanding of what exactly we mean by consolidated financial statements. So